Welcome to the Savant Strategic Approaches to Year-End Tax Planning webinar. My name is Emmanuel Miller. I am one of the tax consultants here at Savant, and I operate like a rover. I just come in and fill gaps and do the things that are necessary and need to get done. And I'm here today with one of my colleagues, Mike.
So my name is Mike Mesh. I have been with Savant. This is my 24th tax season. And I always think it's a good idea at the end of the year to get together with clients, whether in person or via webinar, to talk about just some simple things that we can do to save some taxes at the end of the year and make sure everybody has their bases covered. So I've really been looking forward to this. Like I said, I think we have identified a few things that everyone should think about every year, whether or not you need to update your estate planning. Every year in December, I think it's a good idea to take a look at it. Tax planning and charitable giving. We'll come up with a few ideas that we'll go through that can help you save some real money. And as you look through our slides, we provided a lot of information. We did that on purpose so you could take it back and read it and ask good questions. We're going to go through it at a high level. Some of it might seem like it's not simple year-end stuff, but if you give us a call, that's one of the benefits of working with Savant is we have the wealth advisors and the tax advisors on the same page working together to make sure you're not missing any of these things. So give us a call. We can help you implement these planning tactics relatively easily. We're also going to touch base about business ownership benefits. We'll discuss that. And then I am a business appraiser as well. So I help people transition their business, determine valuation, help negotiate buys and sells and that sort of thing as well. So we're going to touch base on that a little bit, and then we'll have some time for Q&A. So let's get into the next slides here. One more slide. So the next thing, so the first thing we're going to talk about is at the end of the year, there's a couple situations you might be in, right? One of the first situation we're going to discuss is, it might be counterintuitive, but you might have a situation in which we actually need to recognize income and pay some tax. Now, why would we want to do that? We'd want to do it because of a couple of reasons. You might have had a business loss during the year that we know about. If we get together in November and you tell us, for whatever reason, I have these expenses this year in the business and it's going to end up being a loss and it's going to bring my income down pretty substantially. Then we're going to look at, okay, are there any opportunities we can identify to maybe recognize some income and pay a lower tax rate than you would normally pay in other years, or pay a 0% tax rate, perhaps. We'll touch base on that. The first is Roth conversions. This is something that I think everybody should consider every year. The optimal approach, the optimal time to do a Roth conversion is really three things. You've got a year with low income, the market is down, and you've got a long time horizon to keep that Roth money inside the Roth and growing tax-free. Now, you don't have to have all three to have it make sense to do a Roth conversion, but that is optimal. And that's something that you should consider with your tax and your investment advisor each year. And I know from working with some of the Savant advisors that is something that we look at. A Roth conversion, just high level, is taking money inside your IRA and converting it to a Roth IRA. What that does is it causes current year income that you have to pay tax on, but it grows tax-free. And so that's why a long time horizon with a Roth IRA is great, because the bigger it gets, the more time that you have to grow it, the more tax-free benefit you're going to have down the road. Next, we're going to touch base on capital gains. So there may be a year where you've got some losses, capital losses that you've incurred, whether it's a sale of an asset, business type asset, or it's an investment asset, and you've got some losses. Or you have that same situation in which you've got some business losses that I mentioned earlier, and your income is down substantially. We may look at recognizing some capital gains that we can pay at lower capital gains rates than what you would normally incur. We can actually incur a 0% capital gains rate if your adjusted gross income as a married person is under right around $90,000, it shows on the slide. Above that, we're looking at 15 and then to 20. So we could look at, perhaps recognizing some capital gains and realizing a smaller tax benefit than you would if we did it in another year. Now let's talk about on the next slide, a situation in which you might have too much income. This is what most people think of. How do I reduce my tax bill at the end of the year? Some common things that we're going to take advantage of each year, or at least look at, is tax loss harvesting. So this is something that you'd work with your advisor and your tax planner on to look at your portfolio of non-IRA investment assets. For instance, let's say you have a stock, AT&T stock, and you bought it at $120 and now it's worth $100. If you sell that within one of your mutual funds that you own, you could recognize a capital loss, which will offset capital gains that you may have through other investments. Any losses that you cannot use during the year, you will carry forward until they are used up. So it's something that might make sense for you. The logistics of it is you have a mutual fund that has a loss, we sell it, and then you go ahead and you buy a similar mutual fund that has similar investments, right? So we're not want to lock in losses. That's not our plan for you, is to say, oh, you've made a bad investment or something, and we want to lock in those losses. Really what we want to do is just create this tax loss, but allow you to invest in an alternative investment that has similar underlying holdings and let you ride the wave back up, assuming that that's still a good investment for you. So talk to your advisor about that sort of a scenario. Next, we're going to touch base about bunching itemized deductions. So, back in 2017, when the standard deduction was raised significantly, the standard deduction is simply the deduction that the IRS gives everybody to reduce their taxable income. You can either take that or you can take the sum of your allowable itemized deductions. Itemized deductions are your medical expenses greater than 7.5% of your adjusted gross income, a $10,000 allocation of state and property tax expenses, mortgage interest, charitable contributions. Those are the big ones. So if those things add up to greater than, say, around $28,000, then the excess over $28,000, which is the standard deduction, is an additional benefit for you, reducing your taxable income and thereby reducing your tax expense as well. So what we look at is a few things. On the next slide, I won't go through this in detail, but real high level, we look at bunching perhaps charitable donations. So if historically you used to give, in this example, $32,000 to charity every year or every other year, you can see in this scenario under the 2023 year, giving $32,000 allowed an additional tax deduction of $16,900 at the very bottom, over and above what your standard deduction would have been for that year. So you get a benefit, but you don't get a full benefit of the full $32,000 that you gave to charity. And then again in 2025, the standard deduction increased, and so you get a $14,000 benefit. So the total benefit under scenario one here is $31,200. We go to scenario two and we consider bunching our charitable donations. That simply means that we are, and that's the next slide, sorry about that. That simply means that we're pushing those $32,000 contributions all into 1 year. And now you're getting a much bigger benefit in that 1 year. You're getting, you can see at the bottom of the 2024 tax year that you're getting $48,100 of additional tax deduction over the standard deduction. And so the benefit there under scenario two and bunching is you get a $48,000 income reduction benefit versus $31,000 under scenario one. So that's something to consider. If we move on to the next slide, though, and this is what's really interesting, because a lot of times people want to don't want to give their charities a bunch of money in 1 year. And perhaps the charity doesn't want it. Perhaps they rely on, a standard on giving, $1,000 a month or $100 a month, whatever it might be. So something that you can do through set up through Savant, we can help you with, is setting up what's called a donor advised fund. And you can move assets, cash, we'll talk about first, into this donor advised fund. And under the scenario 2 that we just discussed, if you wanted to move $64,000 into this donor advised fund, it would sit and you could invest it, conservatively invest it inside of this donor advised fund. And then you could dribble out money over the next, really however long you wanted to your charities. So you get the deduction in 1 year and it goes into this fund over here. And then you dribble out the money over years. So your charities don't have to, feel a change in what you normally do. Cash is one way of getting money into the donor advised fund. The other way to supersize the benefit is to take appreciated investments. So the easy thing for us would be if you have non-retirement accounts that you have investments with us, you can move assets that have capital gains into the donor advised fund and get the deduction for the full fair market value of those assets. You may have bought them at $100. Now they're worth $500. Normally what you'd have to do is sell them, realize $500, a $400 gain in that scenario, pay tax, and then whatever's left over you could give the charity. Now you can take the full 500, move it directly into the charity and get the benefit for that. So it's a great way to supersize a benefit, and a lot of people really like that option. Next slide is basically telling us the same thing. So just quickly, you move money into the donor advised fund, and then you can, as long as it's out to a 501c3 designated charity, then you can take the money and dribble it out over time. The next slide discusses qualified charitable distributions from IRAs. So if you're over 70 and a half and you have required minimum distributions that you must take, you can identify 501c3 public charity and give money directly from your required minimum distribution to that charity. And instead of, again, recognizing the income on your personal return for that distribution from your retirement account and then giving the net of tax amount to charity, you're just giving it directly to them. You don't recognize the income at all. The only thing to watch out for here, though, is that these qualified charitable distributions, for whatever reason, they're not reported on the 1099 that you get, so the tax form. So you have to make sure that you if you've done it, through a different advisor or something, you need to make sure you tell your tax person that it was done, so that we can get you the deduction for it. Let's go to the next slide. So the 529 college savings plans and UPMA accounts, these are just ways to transfer some money to your kids for college and other things. I think people are generally fairly familiar with 529s. We have until, at least in Iowa here, we have until a due date of your tax return to get those deductions, get those contributions made to 529 accounts. 529s grow tax-free as long as you use them for school expenses, and they're transferable. So if child number 1 doesn't use them or doesn't use them all, you can transfer it to child 2, etc. So you never have to leave it sit in there or pull it out and have there be a penalty or anything like that. You can, with proper planning, you can take full advantage of it. There's a small tax deduction for making a contribution, but the real benefit is the growth tax-free over time to help pay for the kids. And then an UPMA account is really just a transfer to minor's account, moves some of the taxable income over there, but there's not really great benefit there, because once the income gets big enough inside of an UPMA account, you're probably going to have some kiddie tax to pay, or some things to consider, some tax considerations. So most folks that I work with anyway are using 529 accounts quite often, or that's what they ask us about anyway. And then there are also some really cool things now that you can do with 529s and Roth IRAs as well. So something to keep in mind. Estate planning, I just wanted to touch on this briefly. Again, annually, it's a good idea to at least have that check mark. I've checked the box that I do, yes, have my will and trust, and healthcare directive and financial power of attorney set up. If you don't, it's a good time to say, okay, it's a reminder I need to connect with someone to do that. I got notification that you cannot hear me. Can you not hear me at all? Hopefully you can hear me now, and I'll get a little closer. With regards to estate planning, again, you're just going to save some money by having an estate plan available, completed. High level, you just want to make sure that the folks after you pass know where you want your money to go. We can avoid some probate fees and things by having a trust set up. We'd be happy to talk to you more about that. We can do some really fun things with charity as well as part of your estate plan. So if you have an interest in charitable giving, give us a call and be happy to talk through that as well. Let's go to the next slide. All right, this is for Reed.
All right, guys. Well, we're learning a lot of stuff today. I appreciate Mike just kind of going through all that information. Obviously, like you said, if you guys have any questions, feel free to reach out to your advisor, and we'll also provide a link at the end of this webinar for you to engage with us. So one of the things we want to talk about today is business ownership benefits. What are the benefits of owning a business, right? These are things that you can do at the end of the year for tax year-end planning and stuff like that, but also just some good reminders to have if you're a business owner. These are the things that you might want to consider. Mike talked about some of his background. My background is in business consulting. Also looking at it from a tax lens, while also looking at it from an advisor's lens, just trying to make sure that we're saving in the most efficient way possible. So one of the things that people need to consider when talking about having a business is making what's personal business, right? A lot of times people don't necessarily know what it is that they can do once they have gotten a business or once they become a business owner. So here are a few things that you might want to talk with your advisor about or talk to us about, and I'll just go through them here. So let's start with meals. How do you figure out what's a business meal? And so in most situations, a business meal is not anything that you eat alone. But if you're eating with someone else, then in that situation, depending on what that conversation looks like, could be a referral source, could be somebody that's going to lead you to the next deal. Even if you're eating with your friends, these conversations will lead you potentially to. And so you have to start considering the fact that some of your personal relationships, even potentially with your closest friends, are going to lead you to a place where if you're going out and having a meal with them, then it is a business discussion. And that is something that you can run through your business. And you'll be surprised at how often you're talking about what it is that you do. Traveling, a lot of people don't know when and where to actually deduct what's business for travel and what's personal. Well, there are things that you can do to bring those things together. So personal expenses when it comes to what you want to do while you're traveling. There's a thing for people who are business owners. Typically, if you have an LLC, you can take a corporate retreat and you can put anyone you want to put on that board. I would have a conversation with an advisor as to what that looks like, but there's opportunities here to take what's personal and put it on your business when you want to travel. Auto expenses. One of the places when you think about auto expenses is, the things that are business deductible are anything outside of your normal commute, right? So driving from your home to your office is not going to be a business deduction, but going from your office to that lunch, going from your office to go run an errand, going to wherever you're going, potentially from where you are, is going to be a business write-off. And you'd be surprised at how often you're making moves specifically for your business. Advertising and marketing is about being creative here. One of the things that most people don't consider when they're talking about making a donation, let's say you're making a donation to a school, right? Well, if you're making a donation to a school and you're not itemizing your deductions on your personal tax return, you actually don't receive that deduction. But if you're advertising and putting that out there as a sponsorship, then you're able to get that deduction through your business. That's something that you're still going to have a conversation with your tax professional or your advisor to go through. Talking about advertising and marketing also includes potentially putting the people that live with you, your children or whoever, on payroll. You're in a community and you are established as someone that is a brand in itself, and the people that are with you are a representation of that. You will have to work with your advisor as well on that to figure out, okay, how do you justify what that looks like? Other miscellaneous perks as a business owner, there's things out there called 14-day rentals. The beauty of this 14-day rental rule is that if you rent out a property for less than 14 days, then you don't have to recognize the income. Well, the benefit that you receive as a business owner, if you're renting out your home or renting out someplace that you potentially own, if you do it for less than 14 days, you get a tax write-off on your business and you don't have to recognize income on a personal level. Again, that's still going to have to be a conversation with your advisor to kind of help you figure out what it is, because all of this stuff that we're talking about when it comes to taxes is you have to do it the same way you do your investing. It's about how your risk tolerance. What is your risk tolerance, right? And if you don't have the stomach to take some of the risk, then it's not something that you should do. But if you do want to take a little bit more risk, then have a conversation with your accountant, talk about the risk, and be ready to fight if there is something, right? You got to be ready to defend yourself, and we'll be there for you, throughout the whole thing if there is something that comes up. One thing that business owners have the benefit of is having qualified plans, right? So here are three of the, I guess you could say, primary qualified retirement plans that exist out there. But the major benefit is you get tax deferred, you get a tax deduction, and you don't have to recognize capital gains. So what's the purpose of having something tax deferred? Is obviously you don't have to pay taxes on it today. Getting a tax deduction, everybody loves getting a tax deduction. Not paying any capital gains tax, that's a beauty, right? All of these things provide a benefit, but they have to be worked in balance with your personal situation. A SEP IRA or a SEP plan is a situation where an employer is able to put up 20% of their actual income into their retirement plan. So for 2023, the amount that you could put in there is $56,000. $66,000, sorry. But the issue with the SEP IRA sometimes is that if you put in 20% of your compensation, then you're also going to have to put in 20% of your employees' compensation. And depending on how your business is set up, that could get extremely expensive. 401ks, profit sharing plans is a mixture that allows you to put some of that responsibility on your employees to save for themselves, while also being able to provide them with a benefit as an employer. You're still able to get that maximum $66,000 into your retirement account. But the beauty of it here is if you're effectively paying taxes at the highest tax rate, right? And, you want to put in $66,000 into your retirement plan, you're really not looking at $66,000 because you get a tax deduction. That tax deduction will save you $27,000 in taxes. And that's a beautiful thing. So you're really only putting in $39,000 into your retirement plan. So if you got the $39,000 and you're saying that I don't have the 66, well, effectively you do. And there's opportunities here, but like we said before, you need to work with your advisor and work with your tax professional on that. Defined benefit plans is a mechanism that is great for people who are looking to get some additional cash flow into their retirement accounts, and also for people who are looking to exit their business in a couple of years. And so if you're looking to exit, this is a place where you can park some of your money and get a major tax deduction, additional $100,000, additional $200,000 in taxes. And we can start to implement some of those Roth conversion strategies later on down the road when your taxes are at a much lower rate, rather than in a year of you selling your business. Some rewards of business ownership, obviously, you get to build equity, right? Who doesn't want equity, right? You're able to, just continue to grow. The thing that you want to do as you continue to build equity is find a way to diversify. I would say there is a ton of risk of being a business owner and not having diversity and having your stuff or having your money be liquid in other places, so that you can actually mitigate the risk associated with if something happens to you. If you're the primary person that's working there and you don't have everything set up and you disappear and your family is left to deal with it, then it's going to be an issue, because now your business might not be worth what it is. You get to be the leading visionary. I think that's a beautiful thing. You get to put your ideas out there and you get to create, you get to innovate, and you're able to go out in the community and make a name for yourself, however you want to be. You get to choose to do the work that you want to do, right? That's awesome. You get to do what you want, especially if you're making money. Now, this last piece that I'll say is if it cash flows, it's a go. My colleague Mike is about to talk about some transitioning opportunities or just understanding of transitioning. But when it comes to looking at a business, most of the time the bank they don't care. They care about whether or not it cash flows and if you got the expertise to do it, right? And if it cash flows, then it's a go. So if you're interested in potentially looking at buying a business, then you might want to get a consultant involved. If you're looking at trying to sell your business, my colleague Mike can help you with that. And he's going to talk about some of those things right now.
Yeah, thanks, E. Yeah, that goes real well into the next portion of the program here. The next slide, really, what we talk about. So I've been doing business valuation for 23 years. Started out doing valuation for gifting and things like that. So you gift a portion of your business, or you're incentivizing employees and things like that. And I've done as part of an estate plan. And then really what we got into is buying and selling businesses. And I would say a lot of what I do now is helping people buy and sell businesses in a tax efficient manner, as well as just helping them determine a potential valuation or valuation range. First thing I'll tell you is nobody has the magic wand to tell you what your business is worth, but I'll go into some of the approaches that we take as accredited appraisers. So the first piece of this is your business is part of your retirement portfolio, right? We thought it would fit in well as part getting together with business owners and their financial advisor to talk about, okay, we're 5 years, we might be less or further out from the sale of your business, but let's talk about what that business is worth and how that could potentially fund part of your retirement, what you're going to do with the money post-retirement. There are a lot of ways to sell your business. And I mentioned here an income stream or a lump sum, right? You could really mitigate your risk by selling to someone, letting them go out and get a loan from the bank and pay you off in full in year one. Of course, there's going to be taxes to pay, and we'll help you mitigate that, but we'll also help you plan for it and know what that is and make a good decision before you pull the trigger on the sale. We'll also talk about, do you want to sell a portion of the business over time? Perhaps you're selling to someone who's a manager within your business who you've worked with a long time and you trust, and you decide, over the next 5 years, I'm going to sell 20% per year, or I'm going to sell 20% for a couple of years, and then I'll sell the remaining 60%, and they'll go out and get a loan. So we can recognize those gains over time. And maybe that makes sense. And maybe it's necessary as well, because a lot of times folks don't have managers who have enough money, right, to go out and get a loan, and to have enough down payment in order to get a deal done. So what we might do is sell small portions, and we can bonus money out to them. There's all sorts of plans. So let's, at some point when you get there, call me up. We'll talk more about how we can structure that. The next slide, just to give you, again, a high level approach of valuation, what we do, right? We look at 3 approaches to valuation. What are the assets and the liabilities that you have within the business? I always consider that kind of a minimum value for your business, right? Because, if you shut down today, you would take the cash out of the bank account, you'd sell your inventory, you might sell, your trucks and equipment and that sort of thing. You pay off any debt in the business, and the net amount is what you take home. So that's kind of an asset approach. A market approach to valuation is really a number of things. We'll look at similar industry or same industry type businesses and what they've sold. We have resources that can help provide detail as to rules of thumb for certain industries, as well as actual sales that have happened that we can look to. And then there's the income approach. And really what I always tell people is everything is about the income approach, right? Because if you go to a bank, they're going to say, okay, where's the cash flow in order to pay me back if I'm going to give you this loan for this business? And so that's a big part of what I do with business valuation is I help people evaluate their profit and loss statement kind of recast it for, some expenses you might be taking through the business that a new owner wouldn't have or doesn't have to spend money on, to come up with a true cash flow that would be available to pay off the bank. And then we look at what makes sense. So everybody's going to look at that. And if we go on to the next slide, that's the second little check mark there, is using multiple advisors to see all the angles. So whether you're buying or selling, I always advise people, let's talk to your investment person, your tax person, and also reach out to your banker. And if you don't have a good relationship with a banker yet, get one. It makes sense to do it early, and have someone who's knowledgeable about your financials and has seen them year after year and gone through underwriting and that sort of thing. If you have lines of credit. But a banker is going to be the one who has to lend on money. And so if you get their sign off, then I think, that's just another feather in your cap with regard to whatever valuation we're going to utilize for your business. And so there's, with the right type of planning, we can minimize your taxes, we can maximize the value of your business and really fit it into a good plan for your retirement overall. And connect with me, because I'm happy, and really it's part of what I really like to do at the firm. So appreciate it.
Thanks, Mike. So obviously, like we said here, if you guys want to connect, click the link in the chat to schedule a free call, 15-minute introductory call. If you're interested in knowing some of the stuff that we've talked about today, obviously this is on the surface. And so if you want to get into the depths of things, then you can definitely get personal with your situation so that we can customize whatever needs to be done specifically for you. Nobody's the same. Everybody's life is different. Everybody's story is different. And everybody's desires are different. And so, however you've heard what we've talked about today, we're definitely looking forward to some of the questions that we have from you guys. And, one of the questions that we have, Mike, is someone's asking, can you move your RMD to a DAF?
Unfortunately not. It's not allowed. But I think what the point of what I was trying to get by is, historically we used to give charity, and there wasn't a lot of strategic planning relative to it. Now, with the higher standard deduction, we just really need to be strategic in order to get a good tax benefit for it. So you could do a combination of, moving some money from your qualified or your RMD, move it directly to your 501c3 charity that you enjoy. We could also look at capital gains inside of your investment portfolio and set up a donor advised fund. And that donor advised fund is not something you have to use every year. Once you get it set up, and I would certainly give we're coming up here on, what is today, the 8th of November. I would say reach out to your advisor as soon as possible, because some of the times these things take time to set up before the end of the year and then get funded. But it's something you can do 1 year, and then the next year you just let it go. And then maybe 2-3 years from now, you have another high income year and you want to take advantage of it. So reach out to us and we'll be happy to answer any questions you have about that.
Thank you, Mike. One other question that we have right here is basically, can 529s of one child be used by a cousin?
So, and what comes up for me always is the Iowa 529 plan. I'm based out of the Iowa office, but you can, with the Iowa 529 plan, you can move to cousins, nieces, nephews, aunts, uncles.
Thank you, guys.